Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. So you're joining us today ahead of an unusually busy couple of weeks. If we look at the event calendar from a financial market perspective, we are, of course, now only about a couple of weeks away from the US presidential election. That, of course, the first week of November. So that, from a market perspective, obviously has been much anticipated. Question, of course, being, how should investors respond to that? But it's not just the US election, of course. We do have two other events in the interim, which could also be significant from a market perspective. The UK presents its budget next week, and that's, of course, gaining an undue amount of attention. Given the implication it could have for markets, particularly from a currency perspective. And of course, Japan faces some elections which could change the political outlook. So what does all this mean for financial market investors? To discuss that, I'm joined today by Fook Hien, a senior investment strategist here at our CIO office. So welcome again, Fook Hien. Three big events in the weeks ahead. But let's talk about the US election first. How do you think investors should position a couple of weeks ahead of that?
Yeah, thanks, Manpreet. So, you've got the elections happening on the 5th of November, and Trump continues to gain momentum. The US bond yields, the US dollar, and gold, they have surged in recent weeks amid a strong US data. And increasingly, markets are pricing in a Trump presidency and a Republican clean sweep of both houses of the Congress. The Republicans are expected to win back control of the Senate, according to both opinion polls and betting markets. For the White House and the House of Representatives, the polls show the race remains tight, especially in the so-called swing states. In any case, the betting markets indicate that Trump has gained momentum and is expected to win. We believe it is a good time to lock in attractive US bond yields. We are opening an opportunistic idea to buy the 20-year US Treasury bonds to lock in income for the longer term. We believe the recent surge in bond yields is excessive. The bond yield has surged amid concerns that a Republican clean sweep could lead to higher inflation and budget deficits because of Trump's agenda of tax cuts, higher import tariffs, and a clampdown on immigration. But we do expect the US bond yields to eventually retreat, even if Trump wins, given a 6 to 12-month view of a soft landing for the US economy. If Trump does return to the White House, he is likely to be pragmatic and responsive to the markets. As such, any knee-jerk sell-off in the bond markets would likely lead to a recalibration of Trump's policies. And on the other hand, if Harris wins, this is likely to lower bond yields as the Trump yield premium is priced out.
Thanks, Fook Hien. Let's talk about the other two of interest then. We have Japanese lower house elections on the 27th of October and the UK budget on the 30th of October. What are your thoughts on these and how investors should consider incorporating these into their decisions?
Yeah, with the Japan elections, there is increasing concern about political instability after Japan's lower house election on 27 October. And Asahi, a newspaper poll this week, it showed that the ruling LDP Komeito coalition could lose the majority support at the election, and this would force them to force a broader coalition in order to stay in power. Now, such a scenario could weaken the hold of the incumbent Prime Minister Ishida, who is a fiscal and monetary hawk. This in turn puts pressure near term on the Japanese yen. Hence, we saw the US dollar to the yen. It broke above 150 a bit amid a stronger US dollar. However, the yen appears oversold on technical charts. We would lean against further yen weakness as we see increased intervention risk from the Bank of Japan. And in the UK, the Labour government faces its first major test. Chancellor Reeves will be presenting the budget on the 30th of October. And Reeves is seeking to ramp up the UK's long-term growth prospects through higher investments. Although she has ruled out tax hikes for about 70% of the tax base, we expect tax increases to finance the government's ambitious investment plans. The report suggests this could include non-domicile resident tax regime, and VAT on private education, plus tax hikes on capital gains, inheritance, and pensions. So, a key focus for markets will be how the UK government plans to boost the much needed spending and how it plans to finance them. So, Reeves has confirmed plans to adopt new debt rules in the budget that will enable the government to borrow an additional £50 billion to fund the investments, along with promises to reform public services. The Chancellor will be conscious of sustaining market confidence, given memories of a Conservative Prime Minister Liz Truss' mini budget experience. The pound GBP has trended higher since the Labour government came to power. So a well-planned and communicated growth budget could fuel the pound to rally further. And we see the pound benefiting from such an outcome. And we expect the pound to the US dollar faces the next resistance at 1.351, followed by 1.361.
Okay, moving on from, I guess, the big events, one other theme in Asian equity markets, of course, has been potential rotation of foreign investor interest from Indian equities to Chinese equities. Given we're overweight, of course, Indian equities, is that potentially a concern we should be keeping a watch on?
Yeah, India equities have witnessed a pullback after touching an all-time high in September. The foreign investor flows, they totaled approximately about $9 billion in October, month to date, which is the sharpest monthly outflow since March 2020. While the initial outflows, they are arguably driven by reallocation to Chinese equities, several other factors, they likely supported this move. First, the high-frequency indicators, it points to a gradual normalization in economic activity from their earlier strong pace. Secondly, the Q3 earnings in India started on a lackluster note, raising some concerns of downward revisions to 2024 estimates. And finally, Indian equities, they continue to trade at a valuation premium relative to China and other Asian peers. So in the short term, we do expect a volatility to remain elevated in India equities as the markets adjust to these shifts. But on a 6 to 12 months period, we continue to believe our positive view on India equities to be supported by the still robust economic growth and corporate earnings cycle. Additionally, the robust domestic investor flows amid improving financialization of savings and low foreign investor positioning, these are supportive factors for Indian equities. The risk to our views will include any surge in inflation in India, slowing domestic demand, and US and Indian state elections and geopolitics.
All right. And finally, I want to get your thoughts on the outlook for the global semiconductor sector. I mean, we've had some interesting reports in the Q3 earnings season illustrating demand for advanced semiconductor chips. So what do you see as the implications for investors?
Yeah, we're seeing growth in the global semiconductor sector. It appears uneven in the near term. So several large companies in the sector have reported Q3 earnings, as you say, and this is illustrating strong demand for advanced semiconductor chips. So the outlook for the most advanced chips appear positive as capacity remains constrained amid a strong AI, artificial intelligence-driven demand. This growth runway, it could extend beyond the data centers as AI applications are rolled out in devices like smartphones and PCs. Having said that, the demand recovery in the automotive, mobile, and PC markets, which use less advanced chips, these have been slower than expected. We're seeing high inventory levels in these industries, which could dampen and delay the cyclical recovery. Furthermore, sales to China remain subject to uncertainty and likely greater restrictions due to geopolitical concerns. China accounts for a significant 21% of the revenue for the Philadelphia Semiconductor Index. On balance, we do expect the structural AI demand to be supportive of the global semiconductor sector. The cyclical recovery should still come through with a soft landing expected in the US economy. And much of the structural AI demand, it is underpinned by strong cash flows from big tech companies. We continue to be overweight the US technology sector for the structural growth it offers. We expect next week's earnings from the big tech companies to affirm this positive growth outlook.
All right. Well, Thanks very much, Fook Hien, for what's been a really engaging discussion ahead of some big key event risks next week. Always appreciate your insights. If I can just summarize, I guess, the top takeaways from our conversation today. Number one, of course, election being the key sort of event risk in the US, but bond yields have rebounded a fair bit. So we do see an interesting opportunity to add exposure to take advantage of bond yields. Second, of course, the remaining risks from Japanese elections, UK budget, potentially creating opportunities in FX markets. Sterling, of course, that could benefit from a growth budget, but the yen, of course, potentially looking oversold. And finally, of course, earnings pointing to a positive outlook for the global semiconductor sector in the equity market. So we'll bring the conversation to a close there. Thank you, listeners, for joining us today, and we look forward to speaking with you again in a week's time.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.